Hey guys, welcome to the TomatoStocks.com Study Aid program. We aim to provide you free videos for the expensive CPA review courses. So these are all free. So this specific video is about the BEC simulations, and we will post a series of videos for the BEC simulations because that's the new topic and everybody is looking for simulations to understand, to practice more simulations. So our aim is to provide you access to more information and to provide you details about that. So this video is about the payback period and the discounted payback period. Payback period is actually an appraisal method where you will consider the liquidity of the investments. Like you will consider the focus of this method is that you consider the how quickly you recover your investment. So how quickly you recover your investment is a focus point. So this payback period is usually considered by the risk averse investors. So payback period is actually considered by the risk averse investors. So if you're risk averse and you are more concerned about how quickly you recover your investment, so you consider the payback period. The major advantage of payback period is actually this thing, like how you consider the how quickly you recover the investment. But there are like some of the disadvantages of the payback period. For example, suppose I give you examples so that you will understand more better about the payback period. For example, there are like two projects. You have project A and project B. The initial investment of both the projects are same. The time period of the projects are suppose 10 years the same. But in project A, you recover the investment in 3,000 and the profit of the project is 5,000. In project B, your profit is 8,000, but you recover the investment in 5 years. Even though the profit in a project B is more than the profit in project A, but under the payback period you will consider the project A because in this project you will recover your investment in third year, while in the project B you recover your investment in fifth year. So that's a disadvantage because you miss the more profitable investment. The other disadvantage of payback period is the time value of money. Payback period doesn't consider the time value of money in calculating the payback period. However, in discounted payback period, you will consider the time value of money. You will calculate the present value of the cash flows to calculate the payback period. Just so, if the examiner asks you specifically about the disadvantages of the payback period, time value of money is disadvantage. But if the examiner asks you about the disadvantages of discounted payback period, time value of money is not a disadvantage because you already correct because it's a discounted payback period. So focus on this thing, be careful about that payback period and the discounted payback period. In payback period you doesn't consider the time value of money, but in discounted payback period you consider the time value of money. Now we will calculate the payback period and the discounted payback period. This probably will show up in the simulations part of the BC examinations. Suppose West LLP identified a project and CF of the company asked you to calculate the payback period of the project. Suppose the initial investment is $7,000. Suppose in year one you are expected to receive $1,980 of cash flows. In year two you are expected to recover 2,120. In year three you are expected to recover 3,450. In year four you are expected to recover 2,600. In year five you are expected to recover 20,150. We have to calculate the payback period. So in A1 the first, for calculating the payback period, we need to calculate the cumulative cash flows. In year one, the cumulative cash flows is equals to the year one cash flows, which is 1980. So the cumulative cash flow is also 1980. In year two, the cash flow we receive is 2120. The cumulative cash flows is equal to the year one cash flows and plus year two cash flows, which becomes 4100. In year three, we are expected to receive $3,450. So the cumulative cash flows become year one cash flows plus year two cash flows plus year three cash flows become 7,550. We don't need to calculate year 4 and year 5 cumulative cash flows because we don't need to consider it because we already recover our $7,000 initial investment in year 3. Now we have to calculate the payback period. So we need the whole 2 years to recover the payback to initial investment and part of the year 3. So the part is actually 7,000 is the initial investment and we receive and 7,000, and in year 1 and year 2 we already recovered 4,100. So 7,000 minus 4,100 is actually the recovery of the initial investment in year 3. So the cash flow we receive in year 3 is 3,450. So 2,900 divided by 3,450 is 0.84 plus 2 years becomes 2.84 is the payback period. For example, if the examiner asks you about the years and the months, you can calculate it by 2 years is actually the same. The months you can calculate by 0.84 multiplied by 12 becomes 2 years and 10 months. Now we have to calculate the discounted payback period. Suppose the example is same. Western LP identified a project and CFO of the company asks you to calculate the discounted payback period of the project. Initial investment suppose the same $7,000. In year 1, the cash flow is the same 1980. In year 2, cash flow is 2120. In year 3, 3450. In year 4, 2600. In year 5, 2150. And examiner will give you the present value factor, which is the discount rate we consider in this example is 8%. So the present value factors, which will definitely be provided by the examiner, is 0.926, 0.857, 0.794, 0.735, 0.681. We need to calculate the discounted payback period. For calculating the discounted payback period, we need to calculate the present value of the cash flows. The present value of cash flow in year 1 is 1980 multiplied by the present value factor, which is 0.926. So the present value of cash flows is 1,833.48. So the cumulative cash flows in year 1 is the same as year 1 cash flow. Present value cash flow of cash flows, which is 1,833.48. In year 2, we receive 22,120. The present value factor in year 2 is 0.857. Present value of cash flow of year 2 cash flow is actually 1,816.84. The cumulative present value cash flows is actually year 1 present value cash flows plus year 2 present value cash flows. It becomes 3,650.32. In year 3, we receive 33,450. The present value factor is 0.794. The present value of cash flow, year 3 cash flows is 2739.3. The cumulative cash flow in year 3 is actually 6389. So you can see that if we doesn't consider the present value factor, we recover the investment in year 3. But if we consider the present value factor, we need more time to recover our initial investment. So in year 4, we receive 2600. The present value factor is 0.735. The present value of cash flow is 1911. So the cumulative cash flow is 8300.62. So we can see that in year 4 we cover our whole $7,000 initial investment. So we need the whole 3 years plus part of the 4th year to recover our $7,000 initial investment. So the discounted payback period becomes 3 years plus part of the year 4, which is 7,000 is the initial investment minus 6389. we recover cumulative cash flows till year 3 divided by the year 4 present value of cash flows. So the part of the year 4 is 0.32. So the discounted payback period is 3.32. If we need to calculate the months, it's actually 0.32 multiplied by 12 becomes 4 months. The discounted payback period is 3 years and 4 months. So this is how we calculate the payback period and the discounted payback period. So I hope you guys like this example and explanation we explain you. We will provide you more videos and I hope you like these all things. Good luck for the examination. If you like our video, subscribe to our channel. If you need more, if you need videos for the specific topic, put it in the comments. If you need any changes, put it in the comments. And don't forget to visit tomatostocks.com and like our channel, subscribe our channel. Thanks a lot. Good luck for your examinations. Take care. Have a good day. Bye.